It has been confirmed that interest rates in Singapore will be raised by at least 0.25% in end March due to the rising inflation rate in the US. In the later part of this year, we could potentially be witnessing more frequent and smaller increment. And so in this episode, I'll be sharing with you how the rise of interest rates will affect you as a homeowner or buyer in the near terms. Hi everyone, I'm Joy from Propedia. Well, logically speaking, there will be two outcomes from the increase in interest rate. First is that it will result in a higher monthly mortgage. Assuming purchasing a 1 million property at 75% loan to value ratio and 30 years loan tenure. Based on a 1.5% interest rate, the monthly mortgage works out to be 2,588. Should the interest rate be increased to 2.5%, the monthly mortgage payable is 2,900. And at 3.5%, the monthly mortgage is 3,368. There is an increment of approximately $400 for every 1% interest rate hike. And if you were to purchase a 2 million property, you'll be expecting an increment of approximately $800 for every 1% interest rate hike. Lastly, for a 3 million property, these are the monthly mortgage payable based on various interest rates. The rise of every 1% interest rate will result in an additional $1,000 monthly mortgage payable. Having written down the numbers based on various interest rates, it enables you to self-conduct a mortgage stress test. Should you choose to make a property purchase today, it is advisable to determine your comfort level based on an interest rate that is as high as 3% to 3.5%. For existing homeowners who are still servicing a loan that is due to expire, I urge you to refinance soon. Now, on to the second outcome, and that is housing affordability will take a hit, resulting in an oversupply and hence a drop in demand. To better illustrate this point, I will use an example of a buyer who is only comfortable with forking out a maximum monthly mortgage of $3,000 for his property purchase. And based on this, let's have a look at how the increment in interest rate will affect his purchasing power. So, at 1.5% interest rate, he will be eligible for a loan amount of approximately $869,000, which works out to be 1.1 million purchase price. And at 2.5% interest rate, the purchase price will be reduced to 1 million. And given a 3.5% interest rate, the same buyer can no longer afford a property that is more than 1 million. He can only consider properties that cost $890,000 and below. Of course, if he wishes to purchase a property which is worth more than 1 million, more down payment will be required. Based on this illustration, it is clear that if the interest rate continues to rise, it will definitely affect one thing, and that is affordability of all buyers. When affordability is affected, demand will drop. And when demand drops, there is a chance that prices will take a dip as well. Well, what I have shared so far may not be the perfect market conditions for buyers, but it is really dependent on whether you are buying a resale property or a new launch. And so, in my next episode, I'll be sharing with you how the rising interest rate will create a different impact on the resale and new launch market. If you wish to know how, do turn on the notification button for my profile on your YouTube, Facebook, or Instagram. I will see you in the next episode.